Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So when my wife and I bought our house a few years ago, we had to do a significant amount of remodeling. And we ran into a lot of inexplicable things. The previous owners took a lot of, shall we say, shortcuts when it came to home maintenance and home repairs. For instance, there was some termite-eaten wood that they just painted over. I mean, it looked fine, good even, but if you touched it, it basically just caved in because the integrity of the wood was completely destroyed. And no, the damage did not come after the paint. It was obviously a cover-up job. It's really hard to wrap my head around why you would paint over something like that, but out of sight, out of mind, I guess. Or, I mean, maybe they did it right before they sold the house just so we wouldn't notice, right? I don't know. But, you know, a lot of people take shortcuts when it comes to fixing things. I don't know, maybe it's kind of human nature. And this is especially true when it's things they don't want to fix or they simply can't, or they can't afford to. Interestingly, Iran is taking this approach with its money. It's an inflation fix as old as time. Just lop some numbers off the currency and voila, problem solved. Kinda, but not really. The Parliamentary Economics Committee in Iran recently approved a bill to redenominate the rial. And the new currency will still be called the rial, but it will be equal to 10,000 old rials. So imagine if the U.S. government just chopped a couple of zeros off a $100 bill and turned it into a $1 bill. It's like that. Now, according to Iranian officials, the move would, quote, simplify financial calculations, and it will lower the cost of printing the currency. Now, of course, this won't change anything at all for the Iranian people, other than to maybe make the math a little easier, or they won't have to tote around quite so many banknotes. As an Iranian economist told the Financial Times, the scheme, quote, is neither an effective monetary policy nor a mechanism to control inflation. It is simply a formal adjustment to the currency unit for accounting purposes. But it will make government people feel better because it might create the illusion of a stable currency, at least for a minute. Now, the rial has lost significant value in the wake of aggressive international sanctions, but more than that, it's the government's decision to inflate the currency to keep the economy limping along. The annual inflation rate in Iran right now is running between 30 and 40%. The Iranian government finances its massive budget deficits, which of course are a function, somewhat at least, of the economic sanctions. But they finance these deficits, and by deficit we mean the government is spending more than it's bringing in, kind of like here in the United States. But they're financing this by borrowing money from the country's central bank. So when the central bank funds these loans, it uses money created out of thin air. And, the U.S. central bank, the Fed, it employs a similar, albeit less direct scheme to fund the U.S. federal government deficits, which are also massive. It's easy to look over and point at the Iranians and go, your financial situation is a mess. Well, the U.S. financial system is probably a bigger mess if we were really honest. Our inflation isn't quite at that level, but our debt and deficits and borrowing and spending and that certainly are. So the Fed uses quantitative easing programs, and in these schemes, the Fed buys U.S. debt on the open market, goes out and buys U.S. treasuries with money that's created out of thin air, just like the money that the Central Bank of Iran is loaning its government. And basically what the Fed is doing is it's putting its big fat thumb on the bond market. It's creating artificial demand for treasuries because it's buying, right? There's more buying than there otherwise would be. And that allows the government to borrow more than it could otherwise at a lower interest rate. So while less direct than directly loaning money to the government like Iran's central bank, this process in the U.S. has the same inflationary effect. So I don't know, maybe the U.S. is going to get to the point where we're going to have to lop some zeros off the currency. And, again, it's easy to kind of go, gosh, how stupid is this? But the U.S. has taken similar steps because of inflation. For instance, not too long ago, Donald Trump announced that the U.S. Mint would no longer produce pennies. Simply too expensive. It costs more to make a penny than it's worth. And so they're just going to get rid of it. And there's even some talk that maybe the nickel will be next because these lower end of our currency are basically worthless. But anyway, Iran isn't the first country to revalue its currency like this. Israel, Turkey, Romania, and Zambia have all lopped zeros off of their currencies in recent years. And just goes to show, this is part and parcel of a fiat money system, right? When you have money that's tethered to nothing, that the government can create out of thin air when it needs to. It's always going to find a reason it needs to, and you're always going to have this kind of inflationary pressure. Some governments control it better than others, but it's there in every fiat system, including here in the United States. So how did Iran get to the point that it needs to revalue its currency? Well, it's a story that's almost as old as money itself. The government devalued the currency for its own purposes, right? It's good old monetary debasement, and it's been going on for thousands of years. Now, here's the thing. When I run out of money, if you run out of money, we got to figure out some way to earn more money, right? We've got to do something. We've got to work, or we have to do without some stuff. Maybe we have a Visa and a MasterCard, so that can kind of limp us along for a while. But ultimately, we're pretty limited in what we can do when our spending is outpacing our income. But when governments run low on cash, they can just create money and pay for whatever they want, right? They use the central bank as kind of an intermediary, but they have the money creation ability and they use it. And, again, that allows government to do more than it otherwise could. If the government had to rely on direct taxation, pretty much every citizen in the entire world would rebel. So the government kind of makes the pill go down easier by borrowing money, by using this currency debasement trick, by using inflation so that we don't see the extent that we're being taxed. Because make no mistake, inflation is a tax. It is a tax on your wealth. It is a tax on your earning power. It is literally stealing your wealth. It's a stealthy tax, so never forget that. But when money was primarily in the form of gold and silver coins, it was a little bit more difficult for the government to debase the currency. They did it, but it took more work. The monetary debasement in the early days took the form of coin clipping, right? So basically kings and governments, they would just clip a small amount of metal from each coin, and then they take that pile of metal and they make new coins, right? So each coin retained the same face value, but the coins got lighter over time. They had less and less gold. Governments also realized that they could lower the purity of their coins, right? You might have a 90% silver coin. Well, cut down to 50% silver, and your silver goes farther, your real money goes farther, and it devalues the coin, right? It gradually, they add other metals to the gold and silver content, and the coin itself becomes less valuable. And, this works for a while, but people do notice this, right? That was a big problem in Rome. Roman soldiers got angry when all of a sudden they started getting paid in these less valuable coins that contained less precious metal. Now, when paper currency began to circulate, debasement became much easier, right? The government could just arbitrarily revalue the currency's relationship to gold. For instance, if an ounce of gold was valued at $30, the government could bump that up to $40 an ounce, and that enabled the government to issue more paper against the same amount of gold. And today, debasement's even easier, right? The government doesn't even need a paper. It doesn't need a printing press. It can create new money with a few clicks of a mouse. It's literally what the Fed does. So it's easy, again, to look at Iran with a critical eye and call them big dummies for lopping zeros off of their money. However, the U.S. has pulled similar shenanigans. the federal government has just a little bit more of a sophisticated mechanism in its approach. We'll go back to 1933, right? Franklin D. Roosevelt revalued the country's gold. Under the classical gold standard, at the time, the dollar was fixed at $20.67 per ounce of gold. So that meant that it couldn't print any currency that went beyond that value. So it limited the government's ability to expand the money supply. So in 1933, facing the Great Depression, the government's wanting to spend and stimulate. Roosevelt issued Executive Order 6102, which required Americans to turn in their gold over to the government. Some people call this gold confiscation. I think the word confiscation overstates what happened a little bit, because it's not like federal agents ever came door to door and demanded, give me your gold. Most people just turned it over voluntarily. It was kind of an act of patriotism. And a lot of gold never got turned in, to be quite frank. But it did increase the government's gold supply. And since the government had more gold, it could print more currency. But that wasn't enough. So in 1934, the government raised the official price of gold from $20.67 per ounce to $35 an ounce. So in effect, it was a 40% devaluation of the dollar in gold terms. And this allowed Roosevelt and his buddies to massively expand the dollar supply without running afoul of the gold banking requirements. So that wasn't the end of it, of course. In 1965, President Lyndon B. Johnson signed what was known as the Coinage Act and removed all of the silver from dimes, quarters, and half dollars. So you'll notice these are all kind of schemes that went on way back in the past. Nothing new here. So instead of using silver as the primary metal in our coins, the government now mints coins from, quote, composites with faces of the same alloy used in our 5-cent piece that is bonded to a core of pure copper. So sometimes today you'll hear people call coins that were minted before 1965 as junk silver. Those coins still have the silver in them, so people call them junk silver. In reality, we probably should call the modern American coins junk, right? The stuff that you've got in your pocket in the dashboard of your car. That's the true junk. But, if you can find some of those pre-1965 coins, and anytime you get not a nickel, but a quarter or a dime, a half dollar, look at the date. Because if it is 1964 or earlier, it is 90% silver. So keep them, right? The melt value of a silver quarter right now is around $6.77. Think about that. You got this quarter. It's worth $6.77 in silver. Now, you used to be able to find a lot of those older coins in the wild, but people have realized, hey, this is silver. We're not going to go spin this as a quarter. That's just silly. So it's rare to find them now, but you can still get junk silver. And we sell junk silver here at Money Metals. If you go to moneymetals.com, just search for junk silver and you'll find bags of junk silver that you can purchase. And I have some junk silver. I think that for me, one of the reasons that it's great to hold some junk silver is that it makes a great bartering instrument in case there was some kind of economic meltdown, right? You've got this quarter that's worth $6 or $7. You can barter with that. You can spend that as a silver coin instead of as a quarter. And if there was ever a financial meltdown, it would be really great to have those kind of things. But even if you don't, I mean, it's a good way to hold on to some silver. And again, we have that available at moneymetals.com. So check that out when you get a chance if that's something you might be interested in. Anyway, when Johnson signed the Coinage Act, he insisted that removing the silver would have no impact on the value of U.S. coinage. He said, quote, "The Treasury has a lot of silver on hand, and it will be used to keep the price of silver in line with its value in our present silver coin," he said. Yeah. So just a few years later, President Richard Nixon closed the gold window, effectively severing the last connection between the dollar and gold. I'll link to an article on the show notes page that talks a little bit more about Nixon closing the gold window and what that meant and what it did. But in effect, it gave the government free rein to create money without restraint. And Nixon made a claim that was very similar to Johnson's. He asserted, "Let me lay to rest the bugaboo of what is called devaluation." And Nixon promised your dollar will be worth just as much as it is today. Psych. The sad reality is that the government will continue to debase your money because money creation is the lifeblood of big government. And governments will always look for ways to pull the wool over your eyes and make you forget that your purchasing power is declining by the day. Don't be fooled. You need to hold real money. You need gold and silver. The government cannot print away gold and silver. They can't inflate it. It's much more difficult for them to manipulate real sound money. That's why we call it sound money. And make no mistake, I've already alluded to this. Government will inflate the value of your money away. It is as sure as I'm going to be grumpy when I get up in the morning. As sure as the sun's going to come up, government's going to inflate the value of their money or inflate their money. So some governments are going to do it faster than others, but they all do it. And they're doing it here in the U.S. in spades right now. We've seen it in our own bouts of price inflation. But even when they're not talking about inflation, there's still inflation, right? Prices are still going up. The stated policy is to devalue your money by 2% every single year. Now, right now, they're having a hard time getting it back down to that 2%, but that's the plan, right? Why 2%? What's the magic? Why is 2% the magic number? Well, basically because that's a level that you won't notice, right? They can inflate without you getting too upset. When it gets to 4, 3, 4, 5%, people get a little antsy. But 2%, yeah, we can deal with that. So that's kind of the target. But of course, when there's a crisis, they can't quite keep it at that level. So anyway, what is the deal with inflation here in the good old US of A right now? Well, it's alive and well. And no, it's not just because of the tariffs. It's mildly amusing watching the mainstream trying to spin the inflation data that we've gotten recently. They mostly get it wrong because they don't really understand inflation, right? They think that it just means prices are going up. If prices are going up, that's inflation, and that's why we're so fixated on the CPI because it measures this basket of goods, right? And so if that basket of goods, if that price is going up, then we have inflation. Well, no, that's just reflecting rising prices. It is price inflation. So we really should use more precise language. We should say price inflation because when you just talk about prices going up, they're not considering the root cause, right? And as a result, they're all over the place in their analysis. So when the July CPI came out last week, everybody was giddy because there weren't any surprises. The numbers generally came in on the forecast. And markets tend to interpret meeting expectations as good news, even if the expectations weren't particularly good to begin with. And that was definitely the case with the July CPI data. It wasn't worse than expected, but what they expected wasn't particularly good, right? We're talking about core inflation a little over 3%. The thing is, everybody is desperately looking for good inflation data, and sometimes you find what you're looking for, and they're doing this because they want interest rate cuts. And after that CPI report came out, it looked pretty certain that the Fed would finally deal some of that easy money drug. CME Group's Fed Watch increased the odds of a cut in September to 93.9% after that CPI release came out. And the chance of an October cut also moved up from 55% to 67%. So everybody kind of looked at that CPI. They said, ooh, great. Wasn't that bad. Doesn't look like the tariffs are rising prices like people were worried about. And so now, Powell's finally going to give us that rate cut. We're finally going to get the easy money. We're finally going to get out of this tight monetary policy we're in. And then the producer price data came out, and it was not cool. Producer prices rose significantly more than expected in July, throwing markets into a turmoil and calling into question that almost certain Federal Reserve interest rate cut in September. The big jump in wholesale price inflation seemed to confirm worries that aggressive tariffs were eventually going to manifest in higher price inflation. However, if you look a little bit more deeply at the numbers, If you look at that PPI data, it reveals that import taxes cannot be the sole source of this price spike. In other words, the tariffs aren't causing inflation. The producer price index for final demand, so that's the kind of the overall number, it surged by 0.9% month on month in July. And this is all based on Bureau of Labor Statistics data, which, that's kind of questionable, but it's the data that we have, so we're going to talk about it. This was the biggest monthly increase in producer prices since June of 2022. Wall Street had forecast a 0.2% increase in the PPI, so it was a huge miss. On an annual basis, producer prices were up 3.3%, and it was the biggest 12-month increase since February. So if you strip out food and energy prices, core PPI also charted a 0.9% gain, and that was against a 0.3% forecast. So yet again, another huge miss. So what are we talking about here? Well, producer prices reflect the costs incurred by businesses at various stages in the production process. So it's basically the prices that companies are charging each other as they produce goods for final consumption. PPI is considered a leading inflation indicator because companies are going to ultimately pass at least some of these increased costs on to consumers. So PPI that's high today becomes CPI that's high tomorrow, right? Doesn't always happen exactly like that, but generally speaking, when you see PPI jump, when you see a spike like this, it is a warning sign that we could see consumer prices rising and an early indicator of price inflation. Now, when this data came out, mainstream media immediately blamed tariffs for the big jump in producer prices. Good example was high-frequency economics chief economist Carl Weinberg. He told Reuters that the report was, quote, a kick in the teeth for everyone who thought that tariffs would not impact domestic prices in the United States economy. And he added that it was, quote, strong validation of the Fed's wait-and-see approach to monetary policy. And this was typical. We saw a lot of this in the headlines and in the reporting on the PPI, talking about how, this shows it, tariffs are starting to show up in the prices. And it's true. There was some sign of price inflation in goods. Final demand for services, though, is where the bulk of this increase was. Final demand for services exploded by 1.1% month on month in July. Annualized core service prices jumped by 4%. Rising service prices are not a product of tariffs, right? It's goods that get tariffed, not services. A big rise in the cost of financial services drove the services PMI higher. Portfolio management fees soared 5.8%. And this kind of reflects the surging stock market, which I would argue is also a function of inflation. A lot of people don't really realize this. We think of inflation as rising consumer prices because that's kind of the way it's reported, right? We talk about the CPI. It's all focused on consumer prices. But inflation can show up in a lot of different places. And oftentimes it shows up in financial assets before it shows up in consumer prices. You'll see these big stock market bubbles that are caused by inflationary pressures. And I think a lot of the bubble in the stock market right now is a result of inflation. And I'll get to why I think that a little bit more in depth here in a second. But we also saw higher prices for hotel and motel rooms, airline fares, shipping costs, all of those surged higher. Now, to be fair, the price of goods wasn't immune from this inflationary pressure. We saw a 0.7% jump in June. That's pretty significant. I'm not going to downplay it. And this may well reflect some of the cost of tariffs. And we see it on some of the goods that are typically tariffed. Food prices were pushed upward by a big jump in the price of fruits and vegetables. If we exclude food and energy cost, prices rose a more modest 0.4%, and we're talking still here about goods PPI. And so 0.4%. and a notable increase in the cost of steel, aluminum, and primary non-ferrous metals. Again, this is likely a reflection of tariff costs. But while the mainstream has taken the July PPI data as kind of a confirmation of accelerating tariff-related price inflation, the fact that services are leading the way kind of undercuts this narrative because, again, services are not subject to import taxes. Wolf Street, a pretty good analyst, noted that it services inflation at the consumer level that is so hard for the Fed to contain, which is why the Fed fears services inflation so much. So services inflation is it's bad news, right? It's almost worse than goods inflation. I mean, both are bad, let's be honest. And they're both rooted in the same thing. That's really the key here. But anyway, 2/3 of U.S. consumer spending is on services. So when you start seeing service inflation, very difficult on consumers who are having to pay more for all of their services. Core service consumer prices are also heating up. They came in at 4.4% annualized. That was the worst reading in 6 months. And this accounts for 60% of total CPI. So we're seeing this rise in service prices reflected both in producer and consumer prices. So this raises a significant question that I'm not hearing very many people ask. Why did producer price inflation spike when it was driven by services if it wasn't due to tariffs? What causes it? Well, if you're a regular listener to the podcast, you probably know the answer because I've been talking about it for months. It's good old-fashioned monetary inflation. That's the most likely culprit. I've argued for months that the Federal Reserve never did enough to slay inflation, right? Given the amount of money that was pumped into the economy between the Great Recession and the pandemic, nearly $9 trillion. We can see that reflected in the Federal Reserve balance sheet. You couple that with more than a decade of artificially low interest rates, which is also inflationary, raising interest rates to 5.5% and shedding a relatively small amount of money from the bloated central bank balance sheet was not enough to unwind all of that inflation that was created in those decades. Now, it was enough to paper over some of the symptoms. It was enough to bring down the CPI numbers a bit. Still not down to 2%, by the way, but a bit. But it never did strike the root of the problem, right? And I go back and we look at the way the Federal Reserve handled the inflation problem in the 1970s and into the 1980s. We had Paul Volcker as the Fed chair. He pushed interest rates up to 20%. 20%. That's what it took to get the 1970s inflation under control. And I would argue that the inflation was every bit as significant, the recent bout, as it was in the 70s, and yet the Fed went to 5.5%. Now, I will grant you that it is a little bit of a different environment. I don't think we necessarily needed to go to 20, but I don't think 5.5% was sufficient. In fact, if you go back and you look at, kind of the interest rate history in modern times, 5.5% isn't even average, right? We have gotten so used to, so conditioned to artificially low rates that people have a hard time understanding that zero's not normal. I was talking to a friend of mine the other day, and we were talking about the fact that getting old kind of sucks because everything hurts. But there are some advantages to being older, and one of those advantages is perspective, right? You've lived longer, you've seen more, it's easier to put things into a broader context. And I was talking and pointed out the fact that you've got a lot of people that work in finance now that are economists that, are on Wall Street and the stock market and all of these things. They've never known a normal interest rate environment, right? They came in around the 2008 financial crisis, and ever since then, interest rates have been artificially low. So 5.5%, after it's been zero for all of those years, oh my gosh. But it's not enough. The Fed didn't do enough. That's my point. Now, since then, the Fed has cut rates by a full percentage point already. It has slowed down its balance sheet reduction scheme. So it has loosened monetary policy significantly. Meanwhile, the money supply has been expanding for well over a year. As of the end of June, the money supply had grown by more than $600 billion since its low point in mid-2023. As of the end of the month, the M2 money supply stood at $22 trillion, above the peak reached during the pandemic. I'll put a chart on the show notes that shows the money supply, because you'll see how it went way up during the pandemic as the Fed was printing money, as interest rates were held down at zero. And then when the Fed stepped in, started raising interest rates, started shrinking its balance sheet, you do see the money supply drop slightly. But it was very short term. And as soon as the Fed began cutting interest rates, that money supply started to increase again. Now, this is the key to all of this. And I've said this a million times, but I'm going to keep hammering on this until people get it. This is, by definition, inflation. Money creation is inflation. It should not come as a shock that this monetary inflation bled over into producer and consumer prices. It should be no shock that the fact that the money supply has increased over the last year and a half, that we're still seeing remnants and even a revival of price inflation. And as for the notion that we're in this tight monetary environment, oh my gosh, it's so tight, we need looser money. But the Chicago Fed's own National Financial Conditions Index indicates that monetary policy right now is loose from a historical perspective. In fact, conditions weren't even tight at the peak of the Fed's tightening cycle. It almost got to historically tight, but it never got there. And that's why I keep saying that the Fed never did enough to slay inflation. And it's really important to understand that tariffs don't cause price inflation in a generalized sense. Yes, tariffs can cause certain prices to rise, but import taxes don't drive up the general price level throughout the entire economy. Tariffs will raise the price of things that are tariffed. They're not going to raise the price of services and things that aren't tariffed. All things being equal, other prices will drop in the economy as some prices rise on tariff products and consumers adjust their behavior. The market has a wonderful way of sorting these things out. But when you're creating money and injecting new money into the system, that's going to cause prices to generally rise. There is only one thing that causes prices to generally rise throughout the entire economy. It ain't tariffs. It's not Putin's price hikes. It's not greedy corporations. It is an increase in the supply of money and credit. As economist Milton Friedman put it, inflation is always and everywhere a monetary phenomenon. Now, this is going to be a review for a lot of you who are regular listeners, but it is so important. It bears repeating. And of course, we always have new listeners. The mainstream's crappy definition of inflation causes an enormous amount of confusion. And I've alluded to this already as I've kind of walked through this data. People don't understand what inflation really is, right? The fact that we now define rising prices as inflation creates this confusion. It wasn't always that way. Inflation used to be precisely defined as an increase in the supply of money and credit. You can go back and look at a 1970s dictionary, that's the definition you're going to find. If you go back and look at an old economics book, that's the definition that you'll find. We have redefined inflation to just mean rising prices. Now, one of the impacts of monetary inflation is consumer price inflation, or as I've mentioned, asset inflation. You can see it show up in stock markets and art or other assets. But that rising price is not inflation. The inflation is the supply of money and credit, and then that is causing prices to go up, because when you have more dollars chasing the same amount of goods and services, the prices are going to rise. Henry Hazlitt is best known for his brilliant book, Economics in One Lesson. He also wrote another essay. It was titled Inflation in One Page. I can link to that on the show notes as well. And he explained in this essay why using a more precise definition of inflation is crucial. And I think I might have shared this on the show before, but again, it bears repeating, because it really sums up the issue that we have in understanding inflation today. Hazlitt wrote, "Inflation is an increase in the quantity of money and credit. Its chief consequence is soaring prices. Therefore, inflation, if we misuse the term to mean the rising prices themselves, is caused solely by printing more money. For this, the government's monetary policies are entirely responsible." So tariffs make a great inflation scapegoat, but never forget what Hazlitt said. The government's monetary policies are entirely responsible. And that, my friends, I think is exactly why they've redefined the term. They want it to be nebulous. They want you to think inflation is just prices going up, because then they can blame it on everything else in the world. They can blame it on tariffs or Putin or greedy corporations or fairy dust or whatever they want. They don't have to shoulder the responsibility that it is their irresponsible monetary policy, their currency debasement that, as we've established, has gone on from time immemorial. That's what's causing it. They don't want you to know that, because then you'll blame them and you'll get mad at them and you might not vote for them anymore. So the political class would prefer you not grasp this reality because, as I've already mentioned, money creation is the lifeblood of big government. I say this sometimes and people don't necessarily get it, but I'll say the Federal Reserve is the engine that drives the biggest government in the history of the world. Now, it's debatable. I mean, maybe Roman government was bigger. I don't know. But I think if you look at just the pure scope of money it spends and the power it projects around the world, the U.S. is certainly among one of the most powerful governments ever in the history of the world. And the Federal Reserve is the engine that drives that, because there is no way the government could be as big, spend as much money, and do as much stuff as it does if it wasn't for the Federal Reserve enabling the money creation and in effect, propping up the borrowing and spending. So again, that means they're going to blame anything and everything in the world for inflation, so you don't point your fingers at the real culprit, all of them. Sad reality, though, we look at history. We've seen this throughout time, right? The Romans debased their currency. I'm sure it happened before that. So governments throughout history have done this. They're going to keep doing it. You can't stop them, right? There's no voting program that is going to end inflation and money creation. It's just not. We can get maybe some people that are better than others, but, again, go back and look. The stated policy is 2%. They're devaluing your money by policy on purpose. So while you can't change that, you can protect yourself from it. You can shield yourself from it. You can get real money. You can have gold and silver in your hand. You can get junk silver, right? You can get gold coins, silver coins, gold bars, silver bars, even platinum. These things will hedge you. They will protect you. They will store the value of your wealth. If you take that devaluing fiat currency and buy gold and then hold that gold instead of cash, at the end of the day, you're going to end up with more than you had in the beginning, or at least the same amount, because the government's not devaluing away gold. Gold prices going up as dollars devalue. So you need to get your real money. And so this is the perfect time. Call Money Metals today. Talk to a precious metal specialist. The number is 800-800-1865. These folks are fantastic, and they can help you figure out what products will work best for you. They can explain programs. For instance, at Money Metals, we can tell you how you can hold gold and silver in your IRA. So you can have the benefit of physical metal in your retirement portfolio, and we can help you with that. We have other programs. We have vault storage. We have a monthly program where you can build a silver and gold portfolio over time with as little as $100 a month. So talk to them today. I know a lot of people don't like to talk on the phone. I'm one of those people, but you can actually chat at moneymetals.com online. You can chat with a precious metal specialist, and you don't have to talk to anybody, right? You know what you want. You go to the website, you want to get some junk silver, just search for it. It'll pull up. You can buy it. Everything can happen right there online, and we'll get it out to you. So do it today. Don't wait, because the monetary debasement is going to continue. So that's a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything I've talked about on the show today and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, you can join the other 1 million people on our email list. Just sign up for that. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, you'll also be able to tune into our Market Wrap podcast every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. This week, I'm going to be talking with David Morgan. Really appreciate you listening to the show. Thank you so much. If you like what's going on here, please do me a favor. Give us a good review. Hit those like buttons. Share the episodes and help us grow the show. Again, thank you so much for listening. I hope you have a fantastic rest of your week, and I will talk to you again next Wednesday.